Welcome, everyone, and thank you for joining me. Over the past decade, the global economy has been built on one very simple assumption. Money would remain cheap. Governments borrowed freely, corporations loaded up on debt, and financial markets adapted to an environment where interest rates were near zero and liquidity was abundant. That era is now coming to an end. Not abruptly, not with a single announcement, but through a series of signals that are quietly reshaping global financial conditions. Bond markets around the world are beginning to reflect a new reality, one where capital is no longer free and where risk is being repriced across economies. At first glance, this may seem like a technical issue, something relevant only to traders or central bankers. But in reality, bond markets sit at the foundation of the global financial system. When they shift, everything else eventually follows. To understand why this moment is so important, we need to step back and look at how we arrived here. For years after the global financial crisis, central banks kept interest rates extraordinarily low. This wasn't accidental. It was a deliberate attempt to stimulate growth, stabilize financial systems, and prevent deflation. Governments were encouraged to borrow. Companies were rewarded for leveraging their balance sheets. Investors were pushed into riskier assets in search of yield. And it worked, at least for a time. Economic growth resumed, asset prices surged, and financial markets became accustomed to central bank support. Over time, however, cheap money stopped being an emergency measure and became the default condition. Entire economic models were built around it. Now that condition is changing. Inflation, once thought to be a relic of the past, has returned. Supply chains have become more fragile, geopolitical tensions have intensified, and governments, facing rising costs and political pressures, are issuing unprecedented amounts of debt. Bond markets are responding. Yields are rising not just because central banks have raised policy rates, but because investors are demanding higher compensation for risk. Risk tied to inflation. Risk tied to fiscal sustainability. Risk tied to political uncertainty. This distinction matters. When rates rise because of confidence in growth, that's manageable. When they rise because trust is eroding, the consequences are far more serious. What makes the current situation particularly fragile is that multiple pressures are converging at the same time. Major economies are dealing with aging populations, slowing productivity, and growing debt burdens. At the same time, central banks are trying to step back from years of extraordinary intervention. That creates tension. Governments want lower borrowing costs. Markets want higher yields. Central banks are caught in between. Japan offers a revealing example. For decades, Japan was the anchor of ultra-low interest rates. Its bond market was tightly controlled, yields were capped, and investors grew accustomed to stability. But even there, pressure is building. Small signals from policymakers, mere hints of normalization, have been enough to send ripples through global markets. Why? Because Japan is not just another economy. Japanese investors are among the largest holders of foreign bonds, particularly U.S. Treasuries and European debt. If yields at home become more attractive, capital that once flowed outward may begin to return. That has global implications. The United States, meanwhile, is issuing debt at a scale rarely seen outside of wartime. Deficits are large, refinancing needs are growing, and political divisions make long-term fiscal planning increasingly difficult. Bond investors are paying attention. Europe faces its own challenges. Sluggish growth, structural constraints, and uneven fiscal capacity across member states complicate the outlook. As yields rise, the cost of servicing debt becomes a more prominent concern. In all of these cases, bond markets are no longer operating on autopilot. They are asking harder questions. Can governments continue to borrow at current levels? Will inflation remain contained? Will central banks prioritize price stability or financial stability if forced to choose? These questions don't need immediate answers to affect markets. The fact that they're being asked at all changes behavior. Investors become more selective, liquidity thins, volatility increases, and once volatility enters bond markets, it doesn't stay there. Higher yields affect mortgages, corporate borrowing, infrastructure investment, and government budgets. They reshape capital flows and influence currency movements. Over time, they alter economic trajectories. This is why the end of cheap money is not just a financial story, it's a political and geopolitical one as well. Countries that relied heavily on debt-financed growth will feel pressure first. Those with weaker institutions or less credible policy frameworks will face harsher scrutiny. And nations that can offer stability and predictability may find themselves in a stronger position. In the next part, we'll look more closely at how rising bond yields are already reshaping global capital flows, and why this shift could expose vulnerabilities that have been building quietly for years. To see how the end of cheap money is already reshaping the global financial system, we need to look at how capital is beginning to move and, in some cases, hesitate. Bond markets are often described as slow-moving and conservative, but when conditions change, they can transmit stress faster than almost any other financial channel. And that is precisely what we are beginning to see. Japan is a useful place to start, not because it is in crisis, but because it has long been the exception. For decades, Japanese interest rates were near zero, sometimes even negative. Domestic returns were so low that Japanese investors became some of the largest buyers of foreign bonds in the world, particularly U.S. Treasuries and European government debt. This outward flow of capital helped keep borrowing costs low elsewhere. It became an invisible support pillar of the global financial system. Now that pillar is starting to weaken. Even modest changes in Japanese policy expectations have had outsized effects. When investors believe that yields at home might rise, even slightly, the incentive to hold foreign bonds diminishes. Capital doesn't need to rush back all at once. A slowdown in new purchases is enough to matter, and that is already happening. As Japanese yields move higher, global bond markets are forced to absorb more supply with less automatic demand. This puts upward pressure on yields elsewhere, particularly in countries that rely heavily on foreign buyers to finance their debt. The United States is especially exposed to this dynamic. U.S. government borrowing has expanded dramatically in recent years. Large fiscal deficits mean that the Treasury must issue vast quantities of new bonds, not only to finance current spending, but also to refinance existing debt at higher interest rates. This increases sensitivity to changes in investor behavior. For years, strong foreign demand helped smooth this process, but as global yields rise and alternatives become more attractive, that demand is no longer guaranteed. Bond auctions still clear, but at a cost. Higher yields mean higher interest expenses, which feed back into fiscal pressures. Governments then face difficult choices: cut spending, raise taxes, or borrow even more at rising rates. None of these options are politically easy. Europe faces a similar challenge, but with added complexity. The Eurozone is not a single fiscal entity. Debt levels, growth prospects, and political stability vary significantly between member states. Rising yields expose those differences. When borrowing costs increase uniformly, the impact is uneven. Stronger economies can absorb higher rates more easily. Weaker ones cannot. This creates tension within the system and raises questions about long-term sustainability. Markets are acutely aware of this. Risk premiums begin to diverge. Capital flows adjust accordingly. What once appeared stable begins to feel fragile. Beyond government debt, rising yields affect corporate behavior as well. Companies that relied on cheap financing to fund expansion, share buybacks, or acquisitions are now reassessing their strategies. Projects that made sense when money was cheap no longer meet return thresholds. This leads to slower investment, reduced hiring, and more cautious outlooks. Over time, this feeds into broader economic momentum. Emerging markets face even sharper constraints. Many borrowed heavily during the era of low global rates, often in foreign currencies. As yields rise in developed markets, capital tends to flow back toward perceived safety. This puts pressure on emerging market currencies and increases the cost of servicing debt. Central banks in these countries are forced to defend their currencies by raising rates, even if domestic growth is weak. This trade-off becomes more painful as global financial conditions tighten. The result is a world where capital is more selective and less forgiving. One of the most important shifts underway is the repricing of risk itself. During the years of abundant liquidity, risk premiums were compressed. Investors were willing to accept lower compensation for uncertainty, believing that central banks would intervene if necessary. That assumption is now being questioned. Central banks are signaling limits to their willingness or ability to step in. Inflation concerns constrain policy choices. Political scrutiny has intensified, and the sheer scale of global debt reduces room for maneuver. As a result, markets are beginning to behave differently. Volatility has increased. Correlations between assets have shifted. Traditional hedges are less reliable. Bond markets, once seen as stabilizing forces, are becoming sources of uncertainty. This has implications beyond finance. Governments facing higher borrowing costs may find it harder to fund long-term priorities such as infrastructure, energy transitions, or defense spending. Political tensions may rise as fiscal constraints tighten. Social contracts built on expanding public spending come under strain. Geopolitically, countries with stronger balance sheets and credible policy frameworks gain relative advantage. Those that depend heavily on external financing become more vulnerable to shifts in sentiment. The end of cheap money, then, is not just an economic adjustment, it is a reordering of influence. Capital flows shape power. They determine who can act decisively and who must react. When borrowing becomes more expensive, strategic options narrow. This is why bond market developments deserve close attention. They reveal underlying stresses that are not always visible elsewhere. In the final part, we'll look at what this new environment means going forward, whether policymakers can manage the transition, and what risks remain if markets lose confidence faster than governments can adapt. As the era of cheap money fades, the most important question is not whether global financial conditions will tighten, but how well governments and markets can adapt to that reality. History suggests that transitions of this scale are rarely smooth. One of the biggest risks in the current environment is complacency. For years, low interest rates masked structural weaknesses. High debt levels felt manageable. Budget deficits appeared less urgent. Asset prices adjusted upward, creating a sense of stability even when underlying fundamentals were deteriorating. Now those assumptions are being challenged. When borrowing costs rise, fiscal choices become more visible. Governments that could once roll over debt with minimal impact now face higher interest expenses that crowd out other priorities. This forces difficult political decisions, often at moments when public tolerance for austerity is low. Central banks, meanwhile, are walking a narrow path. On one side lies inflation, which demands restraint and credibility. On the other lies financial stability, which sometimes requires intervention. In the era of cheap money, these goals often aligned. Today, they increasingly conflict. If markets become stressed, central banks may be pressured to step in. But doing so risks reigniting inflation or undermining confidence in monetary discipline. If they hold back, volatility could intensify, exposing fragile parts of the system. This tension is already shaping policy communication. Officials speak carefully, signaling flexibility without making firm commitments. Markets parse every word, amplifying small shifts in tone into large price movements. That dynamic itself creates risk. Another concern is the feedback loop between markets and politics. Rising borrowing costs can limit policy options, which in turn affects public expectations. Governments under pressure may resort to short-term measures that provide relief now, but worsen long-term sustainability. At the same time, political polarization complicates coordinated responses. Fiscal reforms are harder to pass. Budget negotiations become more contentious. Uncertainty increases, and markets respond accordingly. This interplay between economics and politics is not new, but it becomes more pronounced when financial conditions tighten. On the global stage, the end of cheap money accelerates divergence. Countries with strong institutions, credible fiscal frameworks, and domestic sources of financing are better positioned to navigate higher rates. Those without these advantages face more difficult adjustments. This divergence affects everything from currency stability to geopolitical influence. Nations that can fund themselves cheaply retain greater freedom of action. Those that cannot become more constrained, more reactive, and more dependent on external support. For emerging markets, the risks are particularly acute. Sudden stops in capital flows can force abrupt policy shifts, triggering recessions or financial crises. Even without a crisis, sustained tightening slows development and reduces resilience. Developed economies are not immune. High debt levels and aging populations limit flexibility. Productivity growth remains uneven, and political resistance to reform remains strong. In this context, the bond market becomes a kind of referee. It doesn't make policy, but it enforces consequences. It rewards credibility and punishes excess, often without regard for political narratives. This is why bond market stress should not be dismissed as technical noise. It reflects deeper questions about governance, discipline, and trust. Looking ahead, several paths are possible. In a more optimistic scenario, policymakers manage a gradual adjustment. Inflation moderates, growth stabilizes, and higher rates become a new but manageable norm. Markets adapt, volatility subsides, and confidence slowly rebuilds. In a less favorable scenario, missteps accumulate. Fiscal pressures intensify, political constraints delay responses, and markets lose patience. Volatility spreads, forcing sharper adjustments. Which path prevails will depend less on short-term data and more on institutional credibility. Clear frameworks, consistent policies, and transparent communication matter more than ever. What is clear is that the era of easy assumptions is over. Cheap money allowed many difficult questions to be postponed. Rising yields forced them back onto the agenda. For investors, this means rethinking risk. For governments, it means confronting trade-offs. For societies, it means adjusting expectations. The transition may be uncomfortable, but it is unavoidable. Bond markets are not signaling collapse. They are signaling change. And change, when ignored, becomes crisis. Understanding this shift is essential, not just for navigating financial markets, but for understanding the broader direction of the global economy in the years ahead. Thank you very much for watching. I appreciate you taking the time to be here. Let me know your thoughts in the comments below. Do you think policymakers are prepared for a world without cheap money? Or are we underestimating the risks ahead? If you found this analysis helpful, please like, subscribe, and share. I'll see you again very soon. Bye for now.